Welcome to the Markets and Performance section. I'm Joe Halwax, Senior Managing Director here at Wespath, with my colleague Karen Manczko. And today we're going to talk about the economy, about markets, about Wespath fund performance, and a little bit of an outlook for Q4 and into 2026. So Karen, welcome. Welcome to our new table, our new studio.
Thank you, Joe.
And I see you didn't wear a Illini orange today.
I did. I wore my usual black attire.
Well, let's talk a little bit about the economy, and let's think about the economy in terms of, say, headwinds and tailwinds. So why don't you start? Can you give us some of the headwinds that we're looking at in the economy right now?
There's definitely some headwinds. And I just want to point out that for most of my section, you're going to hear a lot about inflation and also slowing job growth. So some of the headwinds that I'm going to be covering is, first and foremost, policy uncertainty and government shutdown. This could impact investor sentiment. We could see an impact in the markets because of it. Also, as I mentioned, labor market weakness. We've seen job growth slow, which could raise concerns about economic momentum and ongoing economic momentum, along with inflation. Inflation's been shown to be a little bit sticky, especially in the housing. We know this is one of the things that the Fed is going to be monitoring as they determine if they're going to be increasing or decreasing or rates remaining the same. And then the final one I'm going to point out is the tech and AI theme. Technology and artificial intelligence continues to remain a headline in the U.S. market specifically, as we've seen these valuations trading at an all-time high. So if the market loses confidence in technology and artificial intelligence, this could have an impact on the markets. We're seeing that a lot of these technology companies has a greater concentration in indices like the S&P 500. So if we start seeing a pullback in some of these valuations and stock prices, this could have a greater impact on the market, specifically the U.S. market. But more on the positive side, what are some of the tailwinds?
Tailwinds are more fun to talk about, for sure.
Fun.
Before I get to that, I think when you say inflation, I think of the phrase we're hearing is 3 is the new 2. So we're not going to get back to 2%, so 3% maybe that what we're going to be, stay stuck with now for the foreseeable future. But tailwinds, I've got 2, and I think we probably don't talk about them enough, but they're pretty large. And one is when we look at financial conditions. And by financial conditions, I mean the state of, say, credit in lending, credit spreads in monetary policy. And there's 2 indexes that a finance professor at the University of Illinois points out to. There's the Chicago Fed Financial Conditions Index and the Bloomberg Financial Conditions Index. And both are moving from the upper left to the bottom right, meaning that conditions remain quite loose. So quite loose, financial conditions are supportive for asset markets. And then the second one is the fiscal situation. And in the United States, we're running 6.5% deficits. When we spend more than we take in, that's it's obviously a lot of money, and spending is good. But it's not just the United States. You've got increasingly global deficits were about 3% pre-COVID, and now they're running between 5 and 7, including places that have formerly been quite fiscally responsible, like Germany, and then also China. China's state capitalism model seems to be ramping up their level of fiscal stimulus. So those are 2 really big tailwinds that we see in the markets. So let's switch gears a bit. Let's talk about fixed income, and not Wespath yet, but fixed income broadly. What happened in Q3?
There's quite a few themes that impacted the bond market. First and foremost, the actions taken by the Federal Reserve, and also we've seen the U.S. dollar weakening relative to other currencies. So both of those things had an impact. But starting first with the Federal Reserve. So the Federal Reserve cut rates by 25 basis points on September 17th to a range bound of about 4 to 4.25. This was the first time in nearly a year that the Fed cut rates, which was really the response to slower growth, softer hiring, and also a modest uptick in unemployment. So essentially, these rate cuts were because the Fed sees the risk in the labor market outweighing the inflation risk that we are also seeing. Part of this rate cut also, what we saw was a steepening of the yield curve. So when they cut rates, it pushed yields on the lower end down, while yields on the longer end of the curve remained elevated, which could be due to inflation and also geopolitical risk. So all of this in the background, jumping to the fixed income markets and how they performed. So the U.S. aggregate bond index was up 2.03% in the third quarter, and year-to-date returned 6.1%. So a really strong return for fixed income. We saw Treasury index up 1.5% in the third quarter, and up 5.36% year to date. Now, moving on to the two best performing bond asset classes. First, in the U.S., high yield bonds up 2.54% for the quarter and up a strong 7.22% year to date. And then finally, global bonds, I want to highlight. It returned modest in the third quarter, up about 0.84%, but posted a really strong 8.56% year to date. So emerging market debt and high yield bonds were the strongest performing fixed income sectors. Also, we saw investment grade credits and high yield spreads both at historically tight levels, which is really positive for fixed income assets. The good news is everything I said was a positive contributor to the Wespath fixed income portfolios. But let's shift gears. Let's talk a little bit about equities. Equities are more exciting in my mind. So what do you think?
Yeah, I get to talk about the everything rally in equities. But before I do that, I do think that when you talk about the yield curve steepening, that also goes back to one of those tailwinds. So rising deficits also think about might not be favored by the long end of the bond market. But you'll go on to equities. So as Karen already mentioned, we saw positive markets in fixed income. We also had positive commodity markets, but then we also saw equities rally both U.S., international developed, and also emerging markets. So for the quarter, the S&P 500 gained 8.2%, which brings the year-to-date up to 14.8%. So now we're on the third year of double-digit gains. International emerging markets are performing better. So on the quarter, the ACWI ex-US rose 6.9% and is up 26% year-to-date. So again, just about 11% more than U.S. markets. And emerging markets outperformed on the quarter, up 10.6% on the quarter and up 27.5% for the year. And again, I think we know a lot. We talked about the weakness of the dollar. The dollar's down roughly 10%. It has stabilized, but is quite close to the level of outperformance that we're seeing from international markets and from emerging markets. So a couple interesting things. And Karen, let me give you a question here. How much do you think the S&P 500 is up from the April 7th lows and Liberation Week?
Gosh, I'm not sure, Joe.
It's 38%. So just under 40% from those April, that volatile period that we had. Really also kind of shows us about market timing. Market timing is extremely difficult. But thinking about why we're seeing this rally again, why are we seeing this everything rally? We covered some of the tailwinds, but also you have earnings. So Wall Street expects earnings to rise for about 7 to 8% this year, and this will be the 9th straight quarter of earnings per share rising. We have the mega cap concentration, which stayed high at 40%, but the earnings of those mega cap companies is coming in line. So again, we haven't seen that rollover yet, although we are seeing broader participation as evidenced by the international markets. But I'll give one little caveat that one of my favorite pundits wrote about, John Haybice at DGB Solutions. So since 2018, we're seeing increased levels of fragility, meaning 10 to 20% drawdowns. And the thought about this is that given all the fiscal monetary support, it's also adding to the volatility. So we used to see an event every 14 months, and now we're seeing them about every 7 months. So even since 2018, we've returned 20 or 14% annualized in the S&P 500. It is coming with a great deal of anxiety and volatility. So why don't we move on now and talk about Wespath specifically? So the fixed income funds. Since you cover fixed income, can you cover the fixed income funds?
Yeah, happy to. So as I mentioned earlier, bonds performed quite well for the quarter and year to date, which primarily have been led by global and high yield bonds leading the pack. So for the third quarter, the fixed income fund returned 2.23% versus 2.03% year to date. Things that we kind of mentioned, emerging market debt was the biggest contributor. The fund's overweight emerging market debt, followed by the fund's overweight to high yield bonds. So two of the main contributors to that outperformance relative to the benchmark. Also, the US dollar weakened, as Joe mentioned, and so that had some positive impact with the emerging market currencies that are part of the portfolio, specifically those of Latin America. The year-to-date results were pretty similar. The fund outperformed the benchmark by a little under 1 percentage point. And again, primarily for those reasons I stated earlier, which is the fund's overweight to high yield and the fund's overweight allocation to emerging market debt. The final, before moving back on over to equities, I do want to talk about our inflation protection fund. The fund returned, again, a positive 2.5% versus 2.26% for its custom benchmark. So it did outperform Similar to the reasons for the fixed income fund, the fund's allocation to non-dollar bonds, specifically those of emerging market inflation-linked bonds, was the biggest contributor. Again, those currencies in Latin America and that allocation really helped provide those absolute and relative strong performance. Also, the fund has a 10% allocation to commodities, and the commodities manager outperformed its benchmark by 110 basis points, primarily due to the manager's overweight to strong sectors like precious metals and also livestock. And then year to date, just final note, the fund outperformed by 41 basis points relative to its benchmark. So what about the equities, Joe?
Yeah, let's talk equities. So the U.S. equity fund in Q3 returned about 6% and is now at 9.4% for 2025. So on the quarter, the U.S. equity fund was about 2% under the benchmark of the Russell 3000. And I don't like to sound, sometimes we sound like, like a broken record, but it's a lot of the same things really have been driving these markets. If you go back to November of 2022 with DeepSeek and the rise of AI, the rise of concentration has hurt Wespath and hurt many active fund managers. Only about 25% of active fund managers are beating the benchmark in the past 3 years. Our active manager performance was mixed. 3 out of 6 managers outperformed. And our 6.3% allocation to private markets hurt slightly because, again, when we think about private markets and the delay in reporting, there's always, when public markets are positive, that can be a detractor. On the international equity fund side, kind of boring. We're right in line with the benchmark for Q3. And year to date, the fund's up an impressive 22.6%. Now that is just over 2.5% below the benchmark of the MSCI ACWI ex-US. Couple things on that. So manager selection has contributed, or has negatively contributed slightly. We had 6 out of 8. They're slightly under the benchmark. And year to date, we've had a significant negative contributor was our alt exposure. Looking at alts in the international equity fund, if you go look at a longer term kind of view, which is what we really want to be looking at, the longer term numbers are quite good. However, in the past 3 years, we've seen a lack of exits, which has really weighed on private markets. And then lastly, on the international side, we don't talk about it much, but there's been some headwinds in terms of exclusions. And if you think about what you're seeing is European defense companies, particularly with the pressure on Europe to spend more money from their NATO commitments. So let's think about closing this up, and let's look at the crystal ball for Q4 and for the rest into 2026. So why don't you tell us what we're looking at in the U.S. and then I'll cover international.
Okay. Well, I think for the U.S., we keep hearing, again, inflation, slowing growth. So I think the main risk that we could see domestically could be stagflation risk. So tariffs can lift prices while labor is softening. So this could create stagflation. And obviously, this is a metric that the Fed's going to be watching as it determines what to do throughout the rest of the year. Labor markets concerns, slowing job growth with stable wage inflation. Again, it's prompting the Federal Reserve to prioritize employment risk over that inflation control. Again, those two main themes that we are hearing. Also, we're expecting additional Fed rate cuts that are expected before year end. So the market's pricing in potentially a policy rate of 3.25% to 3.5% by early 2026, which should hopefully provide some positive bond and equity performance with that. But what about internationally, Joe?
I think we might want to mention we hope the government shutdown is over by the time we post.
The government shutdown is over.
But we'll just move on to some of the international. The dollar, right? So international, the dollar has been such a big primary driver of international performance in both stocks and bonds that we're obviously very looking at that in terms of into next year. Some of the headwinds into the dollar remain, so we would look for continued slightly lower dollar, some pressure on the dollar. European economies remain quite soft. In particular, Germany looks like it's about to step into recession again. Again, there could be some policy relief which could help, but there are some economic concerns about, say, Europe, whereas Asia probably looks a little bit better in terms of its economic growth. You mentioned tariffs. Obviously, tariffs. Some of the negotiations we've had could change. Trade realignment, onshoring, right? The speed in which that happens. And then something else I'll take a page of what you talked to about AI and the level of AI and how much it impacts U.S. markets. You do have this global AI race, and particularly with China. Talks about DeepSeek having a product that's very similar to OpenAI at 10% of the cost. So, there are a lot of people that are looking at that and really wondering about the level of capex versus about the level of eventual revenue. So we'll be keeping an eye on the competition we have there with China. So
I mean, definitely lots to watch out for, both domestically and overseas, that we and our managers will be watching closely, and we'll provide you an update on. But that concludes our performance and market update for the third quarter. As always, thank you so much for your trust and your partnership, and we look forward to seeing you all next quarter.